Good morning, everyone. It is the appointed hour, and I'd like to call the August 11th meeting of the Oklahoma City Employee Retirement System to order. Item number 2 on our agenda is to approve the minutes of the meeting of July 14th, 2016. Second. Motion and a second. All in favor? Aye. All opposed? Motion carries. Item 3 is we have some presentations from emerging market managers. Jason, would you like to give us a little preview of who we're going to be hearing from today and what we're looking for?
Sure. So as you all, or some of you may recall, you recently terminated or redeemed from Von Tobel as a result of the portfolio manager, Rajiv Jain, resigned from the firm effective at the end of May, and our thesis behind that strategy really was involved around him. And so you redeemed from that, and the proceeds were reinvested in the State Street Emerging Market Index Fund, so you still have exposure to emerging markets. But today we're here to interview 3 active managers as a long-term replacement, because it's our opinion that we want to be active in emerging markets. The opportunity for managers to add value is there. It's a very inefficient market. You currently have a 5% target to emerging markets of your overall portfolio. That has been split about 60-40 or 3.5% previously to Von Tobel and 1.5% to Wasatch. Wasatch focuses more on the small to micro cap market in emerging markets, so you are getting some small cap exposure there. The 3 managers today primarily are all cap focused, so they're not necessarily focusing on one particular sector of the market. As the chairman stated, we have 3 managers, beginning with WCM, who is here. You also have this clear covered book. It might be helpful, and we'll circle back up, but just for comparison purposes, each manager will have their own book, but page 1 has some information on the strategies. You'll notice there's 4. One of the firms, Wells, we're actually showing 2. It's the same strategy, but 2 different vehicles, and we'll get into that a little bit later. But there's some comparative information on the firms, and then the strategies on the next couple of pages that we can use for comparison. Unless there's any questions about what are we doing and why are we doing it, I'll move to the first manager. Okay. First up is WCM, and I'll let these gentlemen, I think everybody should have their books, and you guys can.
Well, hello and good morning. It's great to be here. My name is Mike Trigg. I'm one of the portfolio managers and principals at WCM Investment Management. We're based in Laguna Beach, California, and I'm joined here by my colleague and partner, and also one of the portfolio managers on the strategy, Sanjay Ayer.
Hi, everyone.
Gentlemen, just as a point of order, it's been our tradition to allow about 20 minutes for the presentation and then 5 or 10 minutes for Q&A. So.
Great. Yeah, that's great. Perfect. The more interactive, the better from my perspective.
You.
So, I'll try not to really rely a whole lot on the book, but if you wanted to turn to page 4, this is probably one of the only slides I think we'll point to today. And this is kind of the proof statement, or this is how we sort of define success from an investment point of view. It's our ability to protect capital. If you want to compound capital over a long period of time, first and foremost, you have to protect it. And it shows, this slide here shows that since the inception of the strategy, we've had a downside capture ratio of 66%. And actually, there have been 66 months since we launched the strategy at the end of 2010. And in those 66 months, the index has gone down 36 of those months, and we've picked up 5,000 basis points of cumulative outperformance. So, I know a lot of managers come in here and they talk about performance, and you can look at what we've done historically or what we've done with other people's money. But the real question I'd be asking if I was in your shoes is, how have you done that historically, and try to give me some confidence that you can continue to do it in the future. And And we're going to talk a lot about investment process and philosophy and the things that we do at the portfolio and stock selection level. But I wanted to spend a little bit of time. I mean, we were sort of sitting at dinner last night when we got in and sort of thinking about, if I was in your shoes, I'd really want to know about the people behind this firm. We can talk process and we can talk philosophy, but if you don't have the right culture and the right people in the business, then none of that stuff really matters. And so, as I said, the firm's based in Laguna Beach. We have 36 employees. 23 of those people are shareholders in the firm. And of the 5 portfolio managers that run this strategy, we're all principal equity owners. I think the combined equity ownership amongst the 5 people is 77%. So the people that run this business and have built this business are also the people that are making the decisions on this portfolio, and I think that is a really important point to make. The other part that's, I think, critical is that ownership has been broadened out significantly over time. Sanjay and I both joined the firm about 10 years ago, and at the time there were 2 co-CEOs that combined owned about 80% of the business, and today they each own 26%. So we've worked really hard to broaden that equity ownership and reward and incentivize the people that have been critical to the success of the organization. And that's also that's a difficult thing to do. A lot of first generation money management firms kind of talk a good game about broadening that equity ownership out, but in practice it oftentimes doesn't happen, which is why you see turnover at firms. And so we've, I think, gone a long way to making sure that everybody's on the same side of the table. We've effectively built the firm, the 5 of us together, and we look at this as kind of a life journey with one another. The other part I would just make is, in addition to ownership, is just tenure, and I think the combined tenure of the 5 portfolio managers is roughly, the average tenure, is 16 years, and Sanjay has the shortest tenure at 9 years. So it's a remarkably stable organization with the same people in place. Even in our operations department, which you may know, operations tends to be the part of the firm where you typically see more turnover. And the average turnover there is roughly 12 years. And in the 10 years that I've been at the firm, we have not had a single person in the operations team leave the business. So, there's a lot of reasons for that. I could talk about kind of the values behind the organization. We talk a lot about fun and gratitude in our business. We really enjoy what we do. I know people don't want to sometimes admit what they do is fun, but that's really how we view it. We really enjoy what we do. We're passionate about it. And then we're also extremely grateful to be in the opportunity that we're in. We'll talk about some of the things I think that are differentiated about what we do. And you can be in this business for a long time and not really do anything that's different, or not find an inefficiency to really exploit. And as we talk about the benchmark and the way we approach stock selection, I think we're just excited to know that we're doing something that nobody else is doing. When we talked about those core values years ago of fun and gratitude, when we developed them at the leadership team level, I was kind of like, geez, I don't know, fun and gratitude. I don't know if that's something I'd ever want to tell a client. But then there was sort of a moment on the drive home where I thought about what Warren Buffett always talks about. And he says, he skips to work every single day in the morning, and he knows he's the luckiest guy in the world, because if he was born in a different part of the world, 85 years ago, he never would have been in a position to put those wonderful capital allocation skills to work. So there's a lot of humility and enjoyment that sort of, I think, permeates the organization.
Yeah, and I think it's good that Mike starts with people and culture, because everything we'll talk about from here on about what differentiates us from a kind of portfolio construction level, from a stock picking level, really emanate from being different, from the culture, from the focus on people. So we're going to touch on a couple of factors that we think are unique, especially in the emerging market space. We'll start with portfolio construction. I think there's 2 ways on a high level to build an institutional grade portfolio. One is to start with the benchmark you're being measured against, and then make some tweaks to it. say, we don't want to own these names, let's overweight these names. So we want to look different, but not too different, because there's this notion of benchmark risk. If you look too different from the benchmark, that you could be held accountable for that. That could work in a few areas of the market, in our view. Maybe the United States markets, where the indexes are relatively efficient. In emerging markets, we would argue that approach does not work. And the reason why is the emerging markets index is really abysmally constructed. If you look at page 24, which breaks down the sector composition of the index, more than half of the emerging markets index is in commodities, financials, materials sectors. These are sectors in emerging markets that are largely state-owned companies. So I would say very poorly run companies, many of which are corrupt, and so these industries are in secular decline. So our standpoint, making tweaks to the benchmark is absolutely the wrong approach. What we do and what we've done is build a portfolio from scratch without looking at the benchmark. And what that leads us to is certain sectors. And it's the sectors you would think are growth sectors here in the U.S. Consumer goods, technology, healthcare. Those are kind of the core sectors we play in, but they're very underrepresented in the index. So as you can see on page 24, where healthcare, the healthcare weight of the EM index is 2.5%. I think over time, the emerging market index will look more like the U.S. index, because you think about where is innovation happening, where is growth happening, where are countries like China and Indonesia trying to reorient their economies. It's exactly towards these sectors. So we want to own the next version of Nestle, the next version of Costco, the next version of Amazon and Google, and having a sector constraint based on the benchmark would not enable us to do that. So we wholeheartedly believe in being different, and we think this differentiation from a sector point of view will pay off significantly over the next 5, 10, 15 years, because again, we think the EM index will look more like the US index, and we're effectively skating to where the puck is headed. So I think just from a construction standpoint, we're fishing in the right pond as it comes to emerging markets.
And not just fishing in a pond that's built out for performance. I just emphasize that this is a less risky part of the market. So when I go back to that downside capture chart that I showed at the beginning, in addition to the stock selection process, which we'll get into, just this pond itself, I think, is inherently less risky because these are more predictable and consistent parts of the economy.
Sure. So we could talk a bit about stock selection. Really the factor that differentiates us the most is how we think about quality. We're labeled as a quality growth manager, right? That's the bucket we're termed as. I kind of touched upon the growth. We believe in these true growth sectors. From a quality point of view, the opposite of quality is junk, right? So no one's going to come in here and say we own a lot of junk. So what does quality really mean, right? What are you differentiating yourself by? I think quality has traditionally meant a few things. One is predictable, sustainable businesses, good balance sheets, low debt. We wholeheartedly embrace all of that. But I think over the last 15, 20 years, quality has come to mean companies with big competitive advantages. So companies like Procter & Gamble, which have a great brand, companies like Walmart, which have a low-cost advantage, and the emphasis on quality is on the size of the competitive advantage. The fancy way of saying it is the companies that have wide economic moats, right? Moats around their business that kind of protect the castle. Our view is different. We think competitive advantages have life cycles. They're not static. And we have found that the direction of the company's competitive advantage is much more predictive than the size of the company's competitive advantage. And so you could think about a company like Dell here in the U.S. and the life cycle of the business, right? If you take a point-in-time approach, snapshot approach, and look for a wide competitive advantage, during Dell's kind of growth cycle, you would have said the competitive advantage is not wide enough, and the company looks expensive. So you would have missed it during its heyday. But once the story started to break and the company missed a few quarters, all of a sudden you say, oh, wow, it does have this wide competitive advantage. It has low cost, great supply chain, great brand, and it's starting to look cheap now that the story is starting to, now that they've missed a few quarters, and you pile in exactly at the wrong time. You pile in on the down cycle, and you get trapped in this notion of wide competitive advantage, and it looks cheap. We're much more focused on companies with growing competitive advantages, and that's really the crux of our stock picking approach. We want companies that are good businesses today going to become great businesses 5 years from now, as opposed to great businesses going to good, and we have lots of evidence that that is the single most predictor of stock price performance. So we have a whole process around surfacing those companies that relies on pattern recognition. And we believe history doesn't repeat itself exactly, but it tends to rhyme, to paraphrase Mark Twain. So we do a lot of case studies on how how competitive advantages have ebbed and flowed over time, and we use that in our stock picking approach. And we think that relying on history, rooting ourselves in history, I think provides a little more evidence that what we're doing is repeatable and sustainable.
Yeah, so if there's any questions on that, we'd be happy to stop. If not, I can talk about, I think, a few more key elements of the investment process. One thing I think, page 19, I think, will just give you a quick snapshot of the actual investment. We've been talking mostly, I think, about philosophy and how we think about building the portfolio and the kinds of companies and the attributes that we look for. And this will put a little bit more structure to that. So one thing I'd like to just emphasize that sometimes I think people don't always get is, the nature of the kinds of companies that we're looking for in emerging markets. There simply aren't that many of them. I mean, if you start with a very simple screen on a Bloomberg machine, for instance, and you do a minimum market cap of $2.5 billion or more, and you exclude some of these obvious industries that we were talking about earlier, utilities, things that just really would struggle to grow faster than nominal GDP. There's roughly 1,600 companies in emerging markets. And if you add a couple sort of basic, very conventional quantitative metrics around, say, a net debt to EBITDA ratio of 2.5 or less, and an ROIC of 10% or more for 5 years, you get down very quickly to about 200 stocks. And from there, and so that's kind of the quantitative pond that we're fishing in. And frankly, I mean, we sort of joke that just based on our earlier comments about sort of where the world's going and which parts of the economy are going to be advantaged in emerging markets going forward, I frankly think you could buy that 200 stock list and probably do a lot better than the benchmark. But when we add our sort of the qualitative things that we look for in a business, we talked about moat trajectory. We haven't spoken about corporate culture yet, but that is something that we look for a lot in the businesses that we invest in. Our own lesson about culture at WCM has actually convinced us that culture needs to be something that we look for in companies as well. But when you do that and you talk about tailwinds and valuation and risks to the thesis, there are basically about 75 companies that are effectively kind of our focus list of stocks. And from there, it's really about doing kind of a daily opportunity cost analysis between making sure that the 30 to 40 positions that we do own in the portfolio are really the best ones. And that's kind of what we do on a day-to-day basis. One thing that's even I think worth pointing out too about the index is, you could look at, the healthcare, even the healthcare weighting, and this will sort of illustrate, I think, how small the universe really is for what we're doing. You can look at something like the healthcare weight. Sanjay identified the healthcare weighting, which is just a couple percent of the index. If you dig a layer deeper and you get rid of sort of the Chinese healthcare companies that we personally would never invest in for corporate governance reasons, or you start to maybe get rid of some of the Indian generic drug firms that don't have growth opportunities anymore. You're dealing with even fewer names. Even technology, which might at face value look like a big part of the index, there's a lot of lousy Taiwanese hardware companies that frankly don't meet the criteria that we're looking for. So there really are only 100 or so stocks, I think, that really ever meet the definition of what we're looking for, and that by its very nature forces you to focus the portfolio. It also explains why there aren't other managers that are doing what we're doing, because again, to do what we're doing, you have to be willing to be different, right? And that means both at the sector level, and it also means you have to be willing to focus the portfolio. And unfortunately, back to what Sanjay said at the beginning, it's an unfortunate thing about the industry, but most people in this industry don't want to be different. And yet we know, if you look at history, that there's a great John Templeton quote: the only way you're going to produce a different result from everybody else is to do something different, and people don't want to do it for whether it's career risk or various reasons. And so I think there's a bit of a barrier to entry in terms of what we're doing. I don't expect many more people to emerge and actually have portfolios similar to this one because of how different it really is. And And I guess one thing I would just emphasize is people might say, okay, you own 30 to 40 stocks. That might seem more risky to me. That might seem like it's going to be a more volatile portfolio. I would just revert you back to those downside capture ratios that I showed you at the very beginning. You know, this is a 66% downside capture. It's a portfolio which has picked up 5,000 basis points of cumulative outperformance when the market has gone down. So this is not an inherently more risky portfolio by the fact that it owns 30 to 40 stocks. Yep. Yep. Mm-hmm. Well, yeah, so, I mean, we've been investing in, so we launched the strategy at the end of 2010. I'm also a portfolio manager on our international and global strategies, as is Sanjay on the global strategy, and we've been investing in emerging markets since the inception of those strategies in 2004. And if you were to actually run attribution on the emerging market component of those portfolios, you'd see that we've actually done exceptionally well in multiple market environments. We are very excited about the outlook in emerging markets. It has been kind of a rough go from an absolute return performance the last few years. But you know, if this is any indication, the weight in if you take our international portfolio that I run, you know, the weight there historically has been kind of in the mid to high 20s. It got as low as sort of 10 or 12% a couple of years ago, and it's back up to kind of the low 20s today. So we're becoming increasingly, as a firm, a lot more bullish about emerging markets as a whole. And I think there's been a couple things that have really changed. There was a time when you could really participate, I think, in the growth of emerging markets by owning developed-only names. Stocks like, a Nestle or some of these, great European franchises that had, built-in brands and distribution in emerging markets that they've been investing in decades. I think that story has changed quite a bit. You now have a slew of very high-quality, professionally run local emerging market companies. So, for instance, we own a stock in a portfolio called Amore Pacific. It's a cosmetics company in Korea. I used to own L'Oreal. They are giving L'Oreal fits in Korea and China right now. We own a stock called Universal Robina, which makes it's a confectionery company, a snack company. They do some beverages. They compete against Nestle in the Philippines and other parts of Southeast Asia. They are taking tons of share from Nestle right now in coffee. So whereas before you had these sort of, somewhat poorly managed local EM businesses, that's changed in a big way. And on the technology side.
Yeah, another big bet in the portfolio you'll see is we own a lot of emerging markets internet companies like Mercado Libre and Yandex and Tencent. And our long-term thesis there is these companies are going to be much, much bigger than their U.S. counterparts over time. And the reason why is you think about how these emerging markets are evolving, it's quite different than the U.S. And the big insight there is that you don't have these entrenched habits and ecosystems in emerging markets. So take China, for instance. In the U.S., there's habits of people going to Walmart once a week or going to Costco. So Amazon is steadily disrupting brick and mortar retail, but it's a steady disruption. There are entrenched habits it has to change. You go to China, there is no kind of history of malls or bricks and mortar retailers there. So consumers are day one being born on the internet, being born on their mobile phones. And so e-commerce is going to be much, much more disruptive and will be much bigger in China than it is here in the U.S. and much quicker. You take advertising, like a company like a Netflix here in the U.S. is disrupting traditional media. But again, it's a very steady disruption. Print media is still big here. Radio is still big. Television is still big. So it's taking time for Netflix to chop away at that. You go to a country like Russia or China, and you don't have those entrenched, the television stations are government-owned. There's no radio print ecosystem. So these companies are going to be much, much bigger. And lastly, social media. Everyone here is excited about Facebook. Facebook's a great company. But again, if you go to China, and let's say I'm going to buy a dishwasher, and I want to know what brand to buy. In the U.S., I might ask my parents, hey, what do you guys own? Oh, it's a GE. That sounds good. You like it for these reasons. I'm going to buy it. In China, you're probably the first person in your family to own a dishwasher. So you're going to rely much, much more on your friends, on your social network. So again, because you don't have these entrenched habits, entrenched ecosystems that have been built over years, we think these companies are going to be 3, 4, 5 times what they are today, and we don't think the market quite appreciates that because they're saying, hey, this company is going to be, company X is going to be kind of the Amazon of Brazil, or company Y is going to be the Google of Russia. And I think that misses the fact that these companies will actually be much bigger than you would think.
Yeah, so there's a team of 9 of us. We are global generalists, and I think that that's something that we're very passionate about. We think that that allows us to make insights about companies that other people can't. So I've done both. My prior employer, I was in a sort of a sector-based coverage world, and what I learned the hard way was that when you have somebody who's a sort of a expert on a given area, they oftentimes can kind of overwhelm you with information when in fact that their conclusions about the business or the stock are completely wrong. And so what we try to really, and it gets back to the cultural aspect of the firm, we really pride ourselves on having a very robust devil's advocate process. This is a very low turnover portfolio, so it's roughly around 30% a year, and so you can just assume that we're not actually adding or selling that many positions. And so when we buy a stock, it's very meaningful to us, and it's one that we want to debate thoroughly. And so having everybody at the table have their own sort of legs to stand on in terms of understanding the business and the industry and the story is really, really important to us. The other part about, I think, being a global generalist is, and Sanjay alluded to it, we talk a lot about pattern recognition at our firm. And so, that can be as simple as saying, hey, I studied how the search market evolved in the U.S. Well, I'll give you a real-time example. One of the stocks in the portfolio is a company called Raia Drogasil. They're the largest retail pharmacy in Brazil. And a big part of our investment thesis is based on looking at how Walgreens evolved in the United States. And, I can just assure you, when I talk to analysts and people on the ground in Brazil, no one's really spent the time or has the experience having actually owned a Walgreens and a CVS and seeing how those business models evolved. And so by being global generalists and spending time in different parts of the world, I think we're able to actually see things that other people don't. And there's actually also a tremendous, the fact that we are running also a global portfolio, that's not, I'm not just relying on history like where I, at a prior firm, owned Walgreens in a different portfolio. We're real time also running a global strategy as well. So, very recently, for instance, we were sitting around and we were talking about this whole trend around athleisure, and everybody's talking about what Under Armour's doing versus Nike and who's taking share. And Under Armour, as you probably know, is making a big push into footwear, and they've been struggling. And so we're kind of sitting around, and we were sort of saying, like, why is it so hard to make a shoe, right? Like, and why is it so? If Under Armour can't do it, why is that? And it occurred to us, let's go find out who the most advanced factories are in the world in terms of athletic shoes. And lo and behold, this was more for Under Armour research. We said, wow, there are actually these companies in Taiwan and China and Vietnam that are actually the predominant manufacturers for Nike and Adidas and footwear. And said, wow, now why don't we actually buy these? This was great because I don't actually have to make a bet whether, Adidas is going to, if Steph Curry is going to have a great year next year, versus, and maybe Under Armour is going to take share in footwear versus, I shouldn't bring up Kevin Durant, but maybe the new KD1 at Nike is, not going to do as well because he's not going to have as good as numbers next year. And so having to sit around as an analyst and make those judgments, that's a very subjective thing to make, but say, hey, if I can just step back and actually own the factory that's going to make all of those for all those companies, and I believe in that trend around footwear and global sports brands and athleisure, that's a very good way to invest. And so, that insight or that opportunity would not have, that light bulb moment would not have happened had we not been sort of taking a global generalist approach.
Okay. We're within about 5 minutes of your allotted time, so.
Yeah, I have a question on page 4 of your downside capture, which you've hit pretty hard. And excuse my ignorance, but on the MCI, MSCI index that you compare to, how much of that is U.S. stocks? Is it zero?
Zero.
Okay. And according to page 23, you've got 10% of revenue in the United States. And this is since 2010, which has been a pretty good time for U.S. stocks, correct? Relative to the emerging markets.
Yeah, that's
So my question is how much of your improvement in downside capture is attributed to the U.S. stock position?
I don't have the exact number for you, but I can. It's small. It's very small. But the fact 10% of revenues is not a significant. I mean, in the grand scheme of things.
Well, if U.S. stocks have gone up 40% since then and emerging markets has been negative, then it probably has more of an impact.
This is saying that, so we do own certain businesses. I'll give you an example, Taiwan Semiconductor. So they're a manufacturer of semiconductors, and some of their customers are U.S.-based semiconductor companies. And so what we're trying to demonstrate here is where the revenues from the portfolio are coming from.
So what percentage of the portfolio is U.S.? It would be a better question.
It's 7% on a domicile basis, and that, this domicile distinction can sometimes be a tricky one. And one of the examples I would give you, we own a stock. It's like a 3 or 4% weight in the portfolio. It's called PriceSmart. It's like the Costco of Central America. 100% of their revenues come from Central America and Colombia, but it was actually started by a guy named Saul Price, who was one of the original founders of what is now Costco. And so the firm's actually based in the U.S., so it's domiciled in the U.S., but 100% of their stores, their business, is actually in Central America and Colombia. But we have to, sort of classify it as a...
No, and even those U.S. domiciles, like a PriceSmart, trades like an emerging market stock, so it's not benefiting from what the U.S. market's doing. In fact, we're pretty deliberate about not playing that game. I think if you look at other emerging markets managers, they want to run $40, $50 billion, and if you want to do that, you have to own companies like British American Tobacco or Nestle or Apple because they have X% of revenue from emerging markets. We think that's a cheat, basically, to run more assets. So we want to own true emerging markets companies that are based in emerging markets, getting the predominance of their value from emerging markets. And if that means running less money, we're fully okay with that because we're trying to generate good returns, not maximize assets. So that from a relative standpoint, relative to our peers, we think we are actually we're not doing any of that kind of backdoor U.S. plays that some of the other emerging market funds you might see are doing.
Any other questions, Council?
Yes, on your diversification, what are some of the thoughts you're really under in financial area?
What are our thoughts on being underweight financials?
Yes.
Well, it's a deliberate bet that we're making in the portfolio. We're very aware of that bet, but it's one that we're very comfortable making. I don't think investing in financials in general, particularly banks, is pretty difficult as a public loan-only equity investor. It's very difficult to kind of find, not only especially in emerging markets, kind of that long history of that long operating history to see how companies have performed through multiple business cycles, which I think if you're trying to make a judgment on a bank and their ability to control risk, I think you need to have some history and see, okay, now I know how this company has performed in different cycles, and that's where I think you'll really tell if there's a real lending discipline there. And that's really hard to do in emerging markets when a lot of these banks have only been public for a short period of time, and they've basically been sort of in a rising asset environment most of the time. So pretty difficult to do. There's also a lot of the banks that Sanjay alluded to that are state-owned that have a significant component that the government's involved in. We do own a bank in India called HDFC, and actually what's really great about that story more than anything else is that they're competing against a bunch of government-run public banks and taking tons of share. They are a true private bank with no government influence or involvement, and that's a much better position to be in. And if you're one of their competitors and suddenly, a friend of the government calls you and wants to do a new infrastructure project, and you have a government official call you and say, you better give that guy the loan, kind of regardless of of his credit worthiness or frankly the sort of utility of the project itself. And so we think that's actually, in that case, that's an advantage, and that's a company that does have a very long history. So there are some isolated examples, but for the most part, emerging market financials are something that we're not interested in or feeling to us.
And there's a history of blow-ups in the industry. I think the notion of a growth bank in many ways is an oxymoron. The companies who chase the growth end up blowing up, and there's been many instances in emerging markets, and I think there'll be many going forward as well. So that's just not a risk we want to take.
Any other questions from the board? Wiley?
Well, it's always difficult to kind of parse, what's rhetoric in a political season versus, what's really going to happen, assuming that particular candidate does get elected. We, by and large, are betting with this portfolio on a lot of domestic consumption. And actually, people don't realize this, but actually, really since 2008, there's been a kind of a deglobalization effect that's taken place. The amount of capital that's actually flowing amongst countries has actually been on the decline. And so some of this is already happening sort of on top of what he's now out there saying. So, at the end of the day, I don't know exactly what impact that would have on us, but I feel pretty comfortable looking at the businesses in the portfolio, knowing that a lot of these really are based on the sort of the domestic consumption in their actual home countries, and not relying on the U.S.
So like Mexico, we own, Walmart of Mexico, we own the Kimberly-Clark of Mexico, all domestic stories, not really playing too much on the export or trade side of things.
Correct. Correct. So yes, there's roughly around $300 million in the strategy currently. We actually have another $200 million piece that's kind of in the final steps of coming in. We did launch we're launching a commingled, but we have a commingled that's set up, seed capital at the moment, and we're very incentivized, obviously, to find a seed investor, which is why we offered the 50 basis point fee. Correct, yeah.
And that fund is set up with all the, set up and ready to take capital, or we potential?
No, it's already set up, and we've done this before, like on the international side, where this is what we did in the same instance. And I do think that that's the right vehicle I think that's a good fee, and I also think it's the right vehicle for you, in that you want to have obviously you don't want to, you want to have full trading flexibility and be able to operate in all these markets. If you did a separate account, it would be a lot, I think, more costly, and there'd be a lot more complications around getting set up in the various countries and being able to participate in the ideas that we're identifying. So I think just from a simplicity and a cost standpoint, I think that the commingled at 50 basis points, I think, is very appealing.
Okay, well, thank you very much.
Thank you.
Thank you.
Any? Good morning.
Oh, morning.
Morning. As we're transitioning, just as a point of order, we would like to keep your entire presentation to about 20 minutes and then allow maybe 5 to 10 minutes at the end for Q&A.
Great. Well, thank you. I'll get us started here. I'm Adam Collins. I'm on the consultant relations team at Wells Fargo Asset Management. And I've been in this role for about 10 years with the firm and worked with Asset Consulting Group, your investment consultant, during that tenure. This is Jerry Caleri. And Jerry Caleri, some of you may have met in the past. He's been working with our Berkeley Street Emerging Markets Equity team now for about 12 years. And I've had the pleasure of working with Jerry as well over the last 10 years at the firm. So Jerry sits with the team in Boston, and he is 100% dedicated to this investment team. There's a few things I just wanted to highlight quickly about our firm, and then I'll turn it over to Jerry to take you through the bulk of the presentation. A few things. We're fortunate to be part of, have a parent company that is very stable, has a great financial resources for us, that leads us to manage our business in the asset management side, right? So Jerry and I and the investment team sit within the institutional group, which is WellsCap. And Berkeley Street is one of our autonomous investment teams. The autonomous nature of our firm is how we're structured, right? We provide on the distribution, the HR, the compliance, all the business functions so that those portfolio managers can concentrate on what they do best, and that's to select stocks for your portfolio. Another thing that kind of falls from the top down from our parent company, in addition to the financial stability and a lot of the resources they provide us, there's a compliance and risk nature that comes down from the top. So you're getting the risk and compliance coming up from the portfolio side. You have it trickling down from our firm and our organization. But we also have an independent risk management team of about 18 individuals housed within our group that is focused on ensuring consistency of our style and our process for you as the client. And this team reports independently. They report up to directly to our CIO and CEO. And essentially, they have quarterly conversations with all of our lead portfolio manager teams across the organization. And that just allows the conversation to flow about all the risks within the portfolio and, again, ensure the consistency of our style and process. So with that, Berkeley Street, like I said, is one of our autonomous investment teams. They manage about $7.5 billion of assets. We are focused exclusively on emerging markets equity. We don't manage developed markets, U.S. markets, or anything else. This team is 100% focused on EM. And they've demonstrated a very long track record, over 10 years, that we've had the consistent leadership. And this team has generated, I think, a very competitive track record, consistent one, in which they take a longer-term approach to their investment horizon. So it's a lower turnover, high quality, and you'll see that they've never underperformed in any rolling 5-year period. And I think that's some comfort that you can have for your board here. With that, I'll turn it over to Jerry to take you through the rest of the presentation, unless there are any questions about our firm.
Good morning, everybody, and firstly, may I thank you for inviting us to come here this morning. I didn't realize we were going to hit 100 degrees, so it's going to be a hot day, but hopefully yours is not too hot in here. Adam has given you a quick introduction as to the firm, what we look for and what we're about. And you're faced with a challenge today. You're meeting a number of managers, and the challenge is to differentiate between us and ultimately come to a decision. And I'm going to stress a number of factors which may help you in this process, because generally managers do the same thing. They end up picking stocks to create a portfolio. But what is the difference? What actually strength can we bring to the table for you? And actually one that you don't have to repeat this process of a search for many, many years to come. So starting from, what are we? As Adam said, this is a 100% focused team. And it's not just purely on emerging markets that's the important element, but where is the research done? Is it done from outside of our team? No. It's done entirely within the team. We don't take research from a central group of people. 100%, every analyst, every portfolio manager is thinking emerging markets all of the time. Secondly, you look at emerging markets as an asset class in the world, and you're familiar with that because you've made decisions already there. There are certain nuances about it. There's certain elements of emerging markets that you've got to take into account in making your decisions. And that is something that we're doing every day, but particularly in the approach we take. And one is the factor of taking a long-term investment view. You know, you can look at markets that go up and down. Emerging markets have gone up 15 to 20% this year alone. So, you know, you have this volatility. How are you participating? How are you capturing the returns? And also, the other very important element is the avoidance of permanent capital loss. If something goes to zero, you do not recover, either in whole or in part. So avoiding of this permanent destruction of capital is a key element in what we do. What do we go about? How do we achieve this? We have a particular approach which is based on a sequential application, and this is on page 11. And it's an approach which says we're interested in two things. One is quality, and then sequentially we look at valuation. Because we don't care about the price of a bad stock. Why would you be interested in a bad stock? Why would you be even interested in a mediocre stock? It'll give you at best mediocre returns. So what we have done over the years is we've taken a top slicing approach to the overall universe. Nearly 3,000 stocks out there. Large cap, mid cap, small caps. And the question is, in a group of 3,000, there's a lot of bad. There's some mediocre, and we want to focus on this process of the quality top tier. Risk management we've referred to as well. Yes, we are very conscious of risk in every decision we take, the research, the portfolio management side, the risk associated with every one of those decisions. Are we getting full transparency of what's going on within a company? Do we really know what's in there? And if we don't know what's in there, are we prepared to commit your capital to a situation that we do not have transparency? The blunt answer to that is we are not. It may be, you know, attractive from the point of view of possible returns, but if we cannot see what we're buying, we will not do that. And then the long-term record. We have a very proud record, never having underperformed over any rolling 5-year period. And I think that is very close. I would never use the word unique because somebody would put their hand up and say we do it or something. But it is a rare occurrence in emerging markets today to have that long record of back to 1997 managing money. We have a portfolio manager that has been in his position for 10 years and never underperformed for any period measured monthly or any 5-year period going back 10 years. So the team, and what do we do? If I briefly move to page 12. And what you can see is we have a team of 9 people there at the end of June. 9 people who are a combination of portfolio managers, analysts, and associate analysts. And looking at emerging markets, it lends itself to splitting it up a little bit geographically. Because what happens in a lot of Asian countries doesn't have an implication on a retailer in Brazil, for example. So you can look at a Brazilian retailer independently of a Korean retailer. And we've split it primarily on a regional basis, Far East, Latin America, and Eastern Europe, Middle East, and Africa. But another element that we've done is we've looked across the overall universe. We said, is every sector equally split out that way? And there are some which you can easily recognize are not. Energy. Energy doesn't matter what's happening in the individual countries. What is important is supply and demand of oil. Saudi Arabia has just announced that it's increased the production of oil. Suddenly that affects every oil company in the world. So we've split out 2 sectors, being energy and materials, that we look on a global basis. So the team is very experienced, very, very comfortable. And that brings me into the thrust, which is under section 4 of the book and goes to page 15. And looking at page 15, I did give you a brief summary of that. But the key issue is avoiding permanent capital loss, at the same time as striving to outperform that benchmark. Because we're an active manager, and if we cannot do that over the longer term, we do not deserve to be considered by you for an appointment. So that has been our goal, and that has been our success. But what is the philosophy we have in getting there? And what it is there, it's emphasized, we're a core offering, and that's a very important element. Because you look at the breadth of the market out there. There's growth stocks, core stocks, value stocks, cyclical stocks. You can put labels on a whole group of stocks. And what we believe in doing is looking at the entire market space, the entire range of options, and pick the best stocks from whatever bin they happen to be in. There's no sin bin in our consideration. There's no segment of the market that we say we will not consider cyclical stocks. because they can be great stocks. The quality of those companies, and the key issue if you want to put them into the portfolio at some stage is the price. So you've got a quality cyclical, you have a quality value stock, you have a quality growth stock. The label doesn't matter. Is it a quality company? And then ultimately at the decision point of portfolio, is it priced correctly at that point in time? So what is quality to us? To better define what I mean by quality. And what we're looking at are companies that have the ability to have sustainable excess return on their capital for reasons we can identify and understand. Sustainable is the long-term approach, not just what are they doing this year and they fall asunder next year, because a barrier to their trade-protected market is gone. So when we look at the sustainability, what's important about the excess return on capital? If a company is growing its capital with this excess, and they do that on a sustainable, continual basis, that is what is adding to the company's intrinsic value, which will keep increasing along with that excess return on capital. And if you have that growth in the value of the company, yes, there may be volatility in the market around that, but you know that you're sailing in a very solid ship and it will be ultimately rewarded by the marketplace. Not every short period, because markets can be triggered by, is the Fed making an announcement or something else, nothing to do with the companies. So what do we do that? And then for reasons we can understand. I referred to already transparency. I'll give you an example of that. Chinese banks, which are among the largest banks in the world today. The problem with Chinese banks is their disclosure. A Chinese bank looking at a bad loan, by Western standards, if the loan stops being serviced, it's default, the bank has to make a provision. In China, no. Goes into default, it's not being serviced. They only have to look at it at the end of their term. If it's a 10-year term loan, it's only regarded as non-performing at the end of that time. So what is the impact of that? We are confident that there is a sizable amount of bad loans that are in the balance sheets of these banks that have not yet been recognized and provisioned for. We don't know how much, but when you look at their need to raise capital, the industries that have blown up in China, there are a fair amount there. We will not put money into those banks on your behalf because we cannot know what's happening there. And that is the depth of what you're trying to dig out in emerging markets. And that's a key element. Yes, at times that hurts us. Chinese banks boomed back at the end of 2014 when they announced a stimulus measure. Quickly evaporated, but over that period it sounded they did very well. We didn't sound too clever. But as the thing unwound, the wisdom of our decision in that regard was well. Now, quality, that's it at the high level. What does it mean at the bottom level? And this is what we're striving to capture on your behalf. It means companies that have a competitive advantage. You know, it's no point in getting an average company that has, just managing to keep going. What is the advantage this company has? Both in what it does and able to grow its market share, able to have pricing power, able to increase its margins. Because that will be what adds to its intrinsic value, to this excess return on capital. Is it financially strong? Has it a huge level of borrowings out there? We don't have an absolute opposition to bank leverage or leverage in a company. But what's important is, what is it being used for? A good acquisition by a company, yes, borrow if it's a very good acquisition. If they are using it for operating expenses, huge red sign and warning. So looking at the financial strength, and then the key issue in most of it, what is the management like? You can look at the quantitative elements of return on this and return on that. Who is driving the bus? What is the experience of that management? What steps have they taken during periods of crisis in the past? Is it a split off from a large conglomerate that has split this company off a number of years ago and management is really managing it for the original owners? These are the elements you've got to fully understand in emerging markets, because there's a lot hidden out there. 23 countries. We invest in about 17 or 18 of them. So what is the practice? We've seen a lot of talk about corruption. Is that endemic in a particular marketplace? How do you discover that? How do you actually take action on that? And that is the element that we're trying to dig in at a minute level to understand the companies that we have focused on. And out of the nearly 3,000 companies, we're not trying to every day look at these companies on a detailed basis. Because as I said earlier on, a lot of them aren't even worth looking at. So we have created over the years what we call a quality pool. Namely, a pool of about 300 stocks that satisfy our quality criteria. And that's been there, that pool has been there for 10 years. The advantage of having a long record in managing portfolios. And that 10-year build-up of the pool, it's one from which we then look at the stocks that are in the pool. They're like bringing somebody home to your mum. Any of these stocks, once we screen them for quality, can get to the portfolio, provided the price is right. And that's the key issue, the secondary element why we view it sequentially. Determine firstly what are the names that you would be happy to own. And then secondly, at what price you will buy these, sell them, and therefore get the returns over the longer term. And that is the dedicated, disciplined process. Because one of the key issues here, having a portfolio manager that has run a strategy for 10 years and been with a firm for a longer period of time, having a disciplined process, we have seen huge volatility in the marketplace, and the greatest temptation is to chase after things. That's one of the unfortunate features of our industry. But having a disciplined process, one that you have a high degree of conviction about, and are able to implement that in a consistent pattern by a team of seasoned, experienced people. So that is, in a nutshell, what it's about. What are we trying to do? I've talked to you about who does it, the dedicated team in Boston. What are they trying to do, which is this issue of identify the high-quality, good companies, then apply rigorous research to those. Dig down into them to the depth of those 300. Not having to dig down for the 2,700, only in the 300. And then from that we pick. And what does the research? A lot of time the analysts spend going on the road. And we don't have our portfolio managers traveling around to do this sort of meeting, that sort of meeting, other sort of meetings, other than investment focus. They are the people that go and see companies to increase our knowledge or increase our focus so that we can make that quality decision. And that is a key element of the approach. How do we do it? The market is broken up by 23 countries. There's sectors, there's countries. We're not concerned about that label and that grouping. We're what we call in the industry bottom-up. Our whole approach to building a portfolio is based on the stocks, not based on if they happen to be in this country or that country. Because there are some great stocks in each of the companies, but there's also bad ones. So if you get the best stock that's in a sector that happens to be in a country with that grouping, that stock is what rewards you. And that is where we approach a bottom-up stock picking with a high degree of conviction on the quality of the company and then applied at the point of strong pricing. Now, does that mean we don't care about what's happening in the world? Do we put our head and just know the company? No. Every single stock that we research, we look at what are the, as we call the macro influences on those stocks. Is it a geopolitical issue? Is it an economic issue in the country? Because even if it's an economic issue in the country, it won't necessarily affect every stock in that country in the same way. So you're able to, by knowing the quality of the company, say, well, here is an exporter in Brazil, Vale, which exports iron ore. Or here is a retailer in Brazil like Lojas Americanas. Now, what's happening within that economy doesn't affect Vale. It used to export all of its iron ore to China at one stage. It's more affected by what's happening in China, not what's happening in Brazil. Conversely, in the case of Lojas, it doesn't care what's happening in China because its domestic market is the Brazilian consumer. So just taking a blanket view of a country and say, we like it or we don't like it, that is to us deficient. You go in there, you find the best companies, brings us back to the quality approach. You find the best companies, you know them intimately, and then you see what are the other external influences that could affect them one by one by one. So you know each of those in turn as they affect the companies. Now, moving down through it, it then comes to the point of saying implementation. Yes, we approach it bottom up, but there has to be checks and balances. We cannot just come along and say, we love Chinese telecoms. Let's load it up with Chinese telecoms. There's a huge risk associated with that. So for every sector, every stock, and the portfolios that we construct, we put limits on the exposure to particular elements so that we're not, again, have an excessive risk position in the portfolio. Coming back to the importance of risk. The risk team that Adam referred to is the team that is external to us. We're applying risk controls in our daily decisions, in our research. And then you've got a separate set of eyes looking at what we do. So that what we say we do, what I stand in front of you and say today that we do, they're ensuring that we're not all off there drifting away from that. Very, very rigorous risk controls. They don't tell us what stock to buy, but they tell us, saying, okay, hold on a second. You're changing your direction. You're changing something. It becomes a discussion point. If we have a justified reason for changing our emphasis, tweaking it, yes, that is acceptable. But if you suddenly find yourself buying developed market stocks, buying Coca-Cola because it gets 30% of its earnings from emerging markets, totally unacceptable. And that is an important issue. We only invest in pure emerging market stocks. And you have the question of, in your domestic portfolio, in your international developed market portfolio, you've got exposure to these other stocks there. There's no point in us doubling up on anything. You're looking to us to provide an emerging market pure exposure, and that's what we give you in the sense of the returns. So how has it ended up for us over the years? As I said at the outset, we have a record of delivering every single 5-year period that is calculated monthly over the last 10 to 12 years. We have outperformed in every one of those. So no matter what date in the past somebody came to us, they did not underperform the benchmark, and that is the key issue. Yes, there are times when the markets shoot up. You come back, the extreme position was back in 2008 and 2009. The market fell one year by 53% and it rose the next year by 75%. There can be extreme movements in emerging markets. There have been some since then. But the key issue is, yes, you have a long, high degree of conviction, long-term perspective that is designed and has succeeded in giving the level of returns that we talk about. I have to say at this stage, and my compliance people assure us, I'm not promising it for the future. But that is what we have striven, and based on our past record, we believe that our clients and prospects like yourself can have a high degree of confidence that we know what we're doing, we've done it for a long time, we've succeeded in achieving those goals, and can come back to you meeting after meeting and explain what we've done. So I think within the 20 minutes, I think I've just about 19 3/4.
You nailed it.
Thank you. Do I get brownie points? No.
Hey, real quick, I just want to cover one last thing in the last minute here. So we have two portfolios that this team manages, right? It's one process, one team, high degree of overlap, but we've talked to Jason and ACG about it. It's essentially our large mid portfolio. Performance since inception, the track record doesn't go back as far, but it's a 4-year track record. It's in the back pocket of the presentation deck that we provided you. So this is just another option to consider, and the reason you may want to consider it is that we are able to offer this in the commingled fund at 63 basis points, which is, from a pricing standpoint, is off our 100 basis point standard fee schedule. So it's a significant discount. It also, it's my understanding that you have another emerging markets portfolio that takes some small cap, and so this portfolio would just basically cuts off the small cap piece. So it may be a better fit for your portfolio. We can do it at 63 basis points. It's totally your choice. We have all the vehicles that you need for either one to invest with. But the all cap we'd still be able to do at 90 basis points, which is 10 basis points off of our standard fee schedule. So I just wanted to make sure, I don't know, that was...
And in that regard, may I just emphasize that you're getting the exact same philosophy that I've described, the exact same team. The whole approach is the same, except we just leave out small caps to which you already got a dedicated exposure.
Yep.
So we're available for
Questions? Yeah.
Any questions from the board? Hearing none, gentlemen, thank you very much.
All right. Thank you. Thank you. We'd love the opportunity to work with you guys,
Thank you.
so appreciate it.
Thanks again.
Thank you.
Gentlemen, good morning. Good morning. Welcome.
Good morning.
Just as a matter of order, you have about 20 minutes for your presentation, and we'll leave about 10 minutes at the end for any Q&A.
Fantastic.
The floor is yours.
Thank you very much.
Good morning. My name is Jim White with William Blair. We're out of Chicago, here to talk about our emerging markets leaders capability. And with me is Bob Dua, who is a partner in our firm and also an equity specialist on the global equity team. There are three key points that we're going to talk about today, and it's kind of woven throughout the presentation. One is independence, the second is performance, and the third is the experience of the team. William Blair was founded in 1935. We are a private partnership, 100% employee-owned, and all active. So what that means is just because you become a partner doesn't mean you can go to Florida and hang out at the beach. You have to contribute every single year, and that partnership resets every single year. And I think that's been a really key ingredient to what is helping us to be able to attract and retain top investment professionals. We do not have a revolving door. I think that's really important. You never like to have headline risk. You never like to have a revolving door. That's William Blair. We're also a conservative firm. We don't leverage the balance sheet. We didn't have any issues in 2008. We got through that very easily. And what that means for you is stability. Stability of the team, stability of the firm, stability of the philosophy process. Second point is performance. We have a tradition of growth in fundamental research, and Bob's going to talk a little bit more about that in a few minutes. And the third is experience. We can't say how important that is, especially in emerging markets. Jeff Urbina, who's one of the two portfolio managers, along with Todd McClone. Jeff has been at William Blair since 1996 and been managing emerging market equities even before 1996. Todd McClone joined in 2000. And he's been on the portfolio since then. So you've got two people that have been working in emerging market equities for a very long time through a lot of different market cycles. That experience, we think, really matters, makes a difference to you. If you could turn to page 5, I'm just going to do a couple more pages, then hand over to Bob to talk about most of the presentation. Page 5 talks about our global portfolio strategies. If you look at the middle part of the blue boxes on the right side, you can see under emerging markets leaders. And we have $3.7 billion in emerging market leaders today. We are going to close at somewhere between $6 to $8 billion. And we've been very lucky to be able to raise, $1 billion recently. So there seems to be a lot more interest lately in emerging market equities. And Bob's going to talk about why now. Why should you think about and pulling the trigger on emerging markets today? We do manage $35 billion overall as a firm. And I didn't say this, but I kind of mentioned closing at $6 to $8 billion. But we always close early. If you ask, ACG, you talk to other people, we're known for being able to close early. And that's the decision, by the way, the investment management teams make, not the sales guys, and not the CEO or anybody else like that. It's the investment professionals. They make that decision. Page 6 on the next page is our representative client list. We're very proud of the clients. We have a very diverse base, but we do manage $15 billion for public plans. And we're very proud of that. Some of those plans are Arizona State Retirement Systems, Oregon State, Texas Municipal, Milwaukee Employees, and Alaska Permanent. Here in Oklahoma, we manage money for Ardmore Institute of Health. We actually have a couple of other plans, too, beside that, but in this area. And we are also very actively involved in CEPRS, which I'm assuming some of you know. We're on the board. We've been very present with that. I feel very fortunate to be part of that organization. On the next page 7, Bob is going to talk a little bit about the team.
Thank you. Jim, thank you. And as you mentioned those client names, it's interesting. I was just out west earlier this week talking to Arizona, talking to Oregon, who are invested in our emerging markets platform, and then literally as we speak, one of our portfolio managers is having a review call with Alaska, which is invested in the same product you'd be looking at as well. So to introduce you to the team on page 7, a couple things I'd like to leave you with that I think are important when thinking about this team. The depth, we have 9 portfolio managers, we have 17 fundamental analysts. There's lots of depth and redundancy among the team. and also the stability that Jim referred to. I want to touch on that a bit. If you look at the way this page is structured, on the top we have the portfolio managers. At the top of the page, our portfolio managers have averaged 13 years of tenure with William Blair. Since 1996, when this team was organized, we've lost one portfolio manager to retirement. We also have 17 fundamental analysts. You can see that in the center of the page. Since 1996, we've lost 3 fundamental analysts. And I think that level of stability is close to unmatched in the industry. And I think about why. I think there's a couple really important reasons that all go back to the partnership approach that Jim talked about. When you look at the fundamental analysts in the middle of the page where it says Global Fundamental Research Team, you'll see a number of those analysts are partners. As a fundamental research partner, as a fundamental research analyst, you can become a partner of the firm. You can be well compensated. Some of our analysts make as much as portfolio managers because their input is valued as much as portfolio managers. So it's a situation where we really value that function. They don't need to be promoted or climb the ladder to become a portfolio manager. We recognize we value research as a career path. So I think that's been very important to the stability and collegiality of this team. When you look at the structure of the team, I mentioned the portfolio managers at the top. The centerpiece really is fundamental research. This is where we do the hard work. These analysts travel the globe seeing companies. They're on the road 40% of the time, traveling to the far reaches of the planet. This is where we do the hard work of meeting with every company that we invest in. But we think in investing internationally, that alone is probably not enough to get the answer right. So we marry that on the right with what we call systematic research. These are proprietary models we've built that look at the quantitative aspects of the same fundamental attributes we're looking for in a company. So we're simply trying to provide a way to manage big data. If you asked us in 1996, part of the challenge when we started this team in managing emerging markets was getting data. Part of the issue today is there's just a huge, massive flow of data. How do you manage that? This technology platform makes it very accessible for us to do so. And then on the left, the last piece is strategy research. And when you think about a fundamental analyst, we're asking them to understand a company inside and out, know their business model, know their earnings trends, know their outlooks, to ask them to have a view on what's going on broadly, economically within China, within Turkey, within Brazil is far too much of an ask. So we have resources dedicated to that to help solve for that piece of the puzzle. And we're not building a top-down portfolio. This is a very much we're picking stocks bottom up. But if you're not aware of these headwinds, tailwinds, and what might affect companies, you're probably missing an important part of the equation in our mind. I'm going to pause there, move on to our philosophy and process, unless there are questions about our team. Okay? So if we'd like to flip to slide 9, a couple things I'd like to point out here that I think are important about our investment philosophy. First of all, I mentioned that we're bottom-up stock pickers, so we're simply trying to find the best companies. So what's our definition of best company? It's a high-quality growth company. I doubt you've had people come in and tell you they're looking for low-quality, crappy companies. But high quality means a lot of different things to a lot of different people, so I'd like to expand upon that for a minute. Often it means defensive, balance sheet strength, able to survive difficult times, low levels of debt. That's absolutely a part of what we're looking for. We think that's really important, especially in emerging markets. But also, more importantly, we think the ability to create returns for shareholders is more important, so we're focused on that as well. And one of the metrics that we focus on a lot is return on invested capital, cash. Cash is king. Earnings can be managed. Cash can't be. Cash is the real deal. So we focus a lot on cash flow generation of the companies that we invest in. If you want to look on slide 10, what we put in the upper left-hand piece there where it says we seek, this, when we think about this, is a report card of a type of company we're trying to invest in. What we're looking for are experienced and motivated management teams that are creating value for their clients. That value is in leading products and services. That tends to translate into leadership within their space, and that in turn translates into strong financial results. This philosophy is something that we've held true to since 1996 when we started the team. Why it's important is that it works. The research shows, if you look in the upper right-hand quadrant of this slide, we take the universe of stocks in emerging markets and break them into quintiles. Quintile 1 are the highest quality companies. Quintile 5 are the lowest quality companies. And what you see over time is that the higher quintiles of quality produce better returns with lower levels of volatility. And that's a theme when you look at our portfolio to come back to, that we tend to produce strong results with lower level of volatility. And then what we hear from our clients that they really like is that in the lower right panel, this up-down market capture, you've probably seen charts like this from ACG. The down market side is what's really important, that you see those quintiles 1, 2, and 3 in difficult times protect better, defend better. And that's intuitive. I think if you're invested in the best companies, when you go through tough times, are they the ones that are able to weather the storm, come out stronger on the other side with better lead managements? That certainly is the case. So that's a bit of a profile of what we're trying to solve for and what we believe in. If you want to look on slide 11 with me, this is an overview of the process and how we execute on that on a daily basis for our clients. This is a time-tested, disciplined process that you can count on as being repeatable. I think our edge is our research, and that's the fundamental work we do, going out and seeing companies. Again, we meet with every company we invest in. We've been doing this for 20 years. We've seen different cycles. We've seen different regimes in emerging markets, and I think that's really important. But we also marry that with this systematic research, and there are pros and cons to both types of research, but we think best in class or best in breed is to use both types of research and integrate them throughout the process, which is what we've done. So really there's 4 steps in terms of how we go from a massive set of stocks we could buy to those that we do. The first step is called this eligibility list. This is simply where we're trying to define a fishing pond. Are these stocks high-quality companies or not? They may not be timely investments, but is it a quality company? We put those in the fishing pond. That's where we spend our time now, is in that fishing pond. The next step, probably the most important one, is setting the research agenda, prioritizing where to spend research. My kids are going back to school next week. They're not real fired up about it, but they're going to get homework assignments. These are the homework assignments for the analysts. We reprioritize every week, discuss, talk in a big conference room. Where should we be spending our time? How's the research going when you're looking at company A, B, C? Are you running into a dead end? If so, let's set that aside, come back to it, let's focus on something else. So it's a live part of the process that occurs every Thursday. We're simply trying to solve for is business getting better at a company? If so, we want to be early in that name. And then step 3, the analysts go do the fundamental analysis you would expect. They're out visiting management, talking to competitors, suppliers, analyzing sell-side research, talking to everybody they can, and coming up with their conclusions about the company. And then the 4th step, finally, is when you have a new idea that an analyst brings to the table, it puts good buying pressure on the portfolio. We have a 70-stock portfolio, so everybody doesn't make it in. So if we've got a great new idea, something has to go out the back door, and that's really healthy for the portfolio. So that's a process that's been repeated time and time again and led to the type of results that you've seen. Slide 12, I'd like to hit quickly, is a profile of our guidelines. A couple things I think are important here. The first one, the benchmarks, the Emerging Markets Index. I mean, this is a pure emerging markets product. We will invest only in companies domiciled in emerging markets. We will not invest in developed market companies with emerging markets revenues. We want to remain very true to your asset allocation and honor that, respect that. It's a well-diversified portfolio. If you look at the number of holdings, 50 to 80, we're about 70 now. We think that's a good balance of being able to have high conviction in names we really believe in, yet be well-diversified so no one stock drives your performance up or down. And then from a risk control perspective, we know you and your consultants don't want to end up with a China bank portfolio, so we have risk controls, but they're broad enough to enable us to express our views. So, for example, a name that we own that shows up here in the portfolio is HDFC Bank. I'd like to spend just a second on to give you an example of the type of company we own. HDFC Bank is a bank that, when stacked up against all the banks in the world, is a very high-quality bank and one of the best. It happens to be located in India. We have a pretty significant position in it. And the reason we do is that in India, most of the banks, 70% of the share in India is owned publicly. These private banks, like HDFC Bank, are by far the higher quality, better banks. They're taking share, they're gobbling away at that. They have some best-in-class online products. And in emerging markets, in many cases, we've skipped the brick-and-mortar, build-to-branch banks all over the world. They're going just to mobile payment structures. HDFC is best in class with that. Their management is as good as any we see in the world. So it's been a big winner in our portfolios, a big position in these portfolios. We own it in broader portfolios where we can also, because it's just a great company that happens to live in India. Okay? Page 14 might be one of the more important ones. We show this to our clients every quarter. It's a scorecard to assure them that we're staying true to what we promised in terms of how we'd construct a portfolio for them. We tell clients their portfolio is going to be very high quality, have strong growth characteristics, good earnings trends. And so you see we've got these metrics laid out. I won't go through every one, but I'd like to highlight a couple. I mentioned ROIC, that cash is king. If you can see, look at that line across, our portfolio has a significant advantage in terms of ROIC, 40% premium relative to the benchmark. Debt to equity, this is a defensive measure of quality. Do our companies have more or less debt? They have significantly less debt. I think that's important. In terms of growth, we have better growth characteristics, and one that is sometimes underappreciated is this reinvestment rate. We really want to see that company management has the same level of conviction in reinvesting in their business as we do investing in their business. We monitor that closely. I think that's an important barometer of the durability or the length of the growth opportunity. Then you go down to valuation, and I attribute this to much like if you're buying a really nice house in a really good part of Oklahoma City, those properties go for a premium price relative to those in neighborhoods that aren't quite as attractive. And so the valuation for the portfolio is higher than that of the market. I would attest and argue that in emerging markets, there are many parts of emerging markets that are cheap and cheap for a reason. And so the fact that we have a premium valuations, we're avoiding some of those maybe value traps as we think of them and paying a bit of a premium for better quality companies with better outlooks, better earnings trends, and we think that's a very fair trade looking forward. And by the way, consistent with what our characteristics have been over time. Page 16 is performance, and I won't belabor this because I know that you've studied this and your consultants have reviewed it, but I'd like to make one point if I can. I mentioned early on that our philosophy of quality growth helps us with downside protection, and clients appreciate that. If you look at the second row of numbers here, the year-by-year numbers, it has been a very difficult time in emerging markets for the past 3 years. We're proud and our clients are happy that in those difficult times, we've protected their capital and provided strong relative returns, and especially in 2013 and 14, positive absolute numbers in negative times. We can't promise that, but we definitely are striving hard to provide downside protection in difficult market environments. And that's held true every year since the strategy's been in place, with the notable exception of 2008. And we probably weren't the best marketing geniuses to start an emerging markets product in 2008, given the financial crisis, but the product has done extremely well since then. And then on slide 17, I think this is kind of getting to the punchline. Number of graphs, let me try and explain them quickly. The first bar chart there is a return chart, and you can see we provide strong returns, sort of top third returns over the last 5-year time period. We're not the hottest dot on the chart, but we do provide those returns in the next bar chart with very low standard deviation. And so when you combine that together, that produces a strong relative return perspective or risk-adjusted return perspective that our clients have appreciated. And then on slide 18, this is a chart that shows if you're sitting in a review meeting looking at a manager's 5-year number, every 5 years since the product has been in place, you can see that you'd have had a positive relative performance outcome with this strategy every time you looked at that since the product has been in place.
You do Bob the why, a couple minutes on.
So the last thing I want to touch on is our thoughts on emerging markets right now. If you could maybe turn to slide 34. I've been on the road all week out west talking to some of our larger clients because we're pretty excited about emerging markets right now. And the slide on page 34 is something our portfolio managers put together at the end of January, early February, when we were sort of at the darkest of bowels of how bad emerging markets were and were probably going to be. And their premise was what could go right. And what could go right would be, what if we see more stabilization out of China? What if they don't have any more policy guffaws? What if they don't devalue the RMB? Well, we've sort of seen that. That's happened. Now, no promises on China, but things are better there. We tend to have a mixed view on China. We think part of China is definitely in recession, but there's clearly great growth within the internet, the travel, the tourism, the consumption side, and we find some great opportunities in there. We're underweight China, but overall mixed. What if in the U.S. the Fed tightening cycle is continually stalled? And it looks like it has been again for at least a few quarters. That takes some relief valve off of emerging markets. What if the commodity complex stabilizes? You saw the commodity complex just get crushed in the last couple of years. If that even just stabilizes, probably a better environment for emerging markets. This is probably the most important one. What about growth rates in emerging markets relative to developed? That's been the big deal for the past 5 years. You've had the emerging markets growth rate decelerating as the U.S.-led developed world's been coming up the curve in terms of growth coming out of the global financial crisis. That's not a good environment for emerging markets as an asset class. We see that changing. We see growth in emerging markets improving. We're seeing that at the company level when our analysts come back from trips, even to Brazil. We've had investments in Brazil, been very successful the past couple of years despite the noise. So we're pretty excited about the growth outlook and the earnings outlook at the company level within emerging markets. And that is because valuations in emerging markets are very cheap. We could look at a bunch of charts on that, but they're cheap relative to themselves and relative to history and relative to the rest of the world. So if you look at putting our money where our mouth is, we have broad portfolios we manage internationally that can go from 0 to 35% in emerging markets. We hit our all-time low of 10% last summer in that product. That's been ramped up over the past several months, and we're now at 20% emerging markets.
I think that's it, Bobby, time-wise. I'm a clock keeper, so I think that's 20.
Question. You had mentioned trying to stay true to the emerging markets class, and so can you clarify, like, at what is your process when those emerging markets become mature, and what is the replacement process or whatever you talked about at the very end of that chart?
Yeah, it's quite simple. For this product, we fish only from stocks that are classified as emerging markets countries by MSCI, the benchmark. So if a country is removed from emerging markets and moved into developed markets, that comes out of our universe and we're out.
Anyone else? Jason, you good? Okay. Gentlemen, thank you very much for taking the time to meet with us this morning.
Thank you very much for having us. Yeah, very much appreciate it. Thank you. All have a great day.
Thank you.
Bye-bye. Thank you.
So now that you've heard all three, just any questions? I can give a few distinctions, high-level distinctions or comments. I think even talking from that page 1 in our book is probably the most helpful.
On wells, we have it broken out where they've been around since 1997, but the other one's broken to 2012, but they really have that experience going back.
Right. So just to touch on that, we show both wells. These are two vehicles. There's really one strategy, one team, one team, one philosophy. The second column there is their all-cap strategy that's been, that the inception was 1997. That goes down into small cap as well. They created the new mid to large strategy in 2012 because they had actually closed the all-cap strategy because there was investing in smaller caps, so they didn't have capacity.
Okay. Does WCM have the same type of situation? Do they have more? I mean, they basically started 2011.
No, so WCM, this is a new strategy altogether. The distinction, a couple of high-level distinctions, starting with WCM. So WCM is a boutique firm focused on non-U.S. equity. Their flagship strategy is their global non-U.S. strategy. That includes emerging markets. So it would be more like your Harding Loevner or Lazard. It's a primarily developed, but it will have some emerging, and that's what he was talking about. It has up to 20 to 30% at times on an opportunistic basis. This dedicated EM strategy that we're talking about today was, the inception is 2010. The assets in that strategy are we show 228 million. They've added a little bit. They've got about 300 million. Most of that is in a couple of separate accounts and a mutual fund. they have created a commingled fund that you could invest in, and the reason why that's more attractive than a separate account really doesn't make sense at your size, because of the cost of what it would cost at your custodian to open up all of those sub-accounts and all of those markets. So they're offering a very aggressive fee structure for you or others that would be early adopters or basically the first movers at 50 basis points all in. So that's a very aggressive fee. Generally, the cost at this size is going to be 120 to 150 basis points, because it's not just the asset management, but it's the custody. They're going to pick up all of those costs.
And just to add, that's not unusual either. So when Wells Capital did their mid to large cap strategy, they did the same thing. The first investors into that strategy were offered a reduced fee structure, and they were offered the 63 basis points, and that's what they're offering you guys today as well.
We were able to secure that because we have several other clients that are in that mid to large strategy, and we're early investors in that. The other distinction with Wells, while Wells Capital is the largest of the three firms that you're talking to here today in terms of strategies and assets under management, this particular team, the Berkeley Street EM team, of the three firms we're looking at, they're the only team that is dedicated exclusively to emerging markets. So the WCM firm and team is focused on non-U.S., that's both international, developed, and EM. Wells, the Berkeley Street team, only does EM. They're not managing any other products. William Blair, you have a fairly large firm, $56 billion in assets under management, partnership structure, so they are owned by the investment professionals. They are relying on a dedicated an analyst pool that covers industries and regions globally, and then the portfolio managers that construct the portfolio are dedicated to this product.
A couple other distinctions, too, is WCM's portfolio tends to be concentrated, so they're going to own a smaller number of securities in the portfolio, whereas William Blair and Wells Capital own a larger number of securities. So you see on page 1 here, the WCM's holdings range from 20 to 50. So one security that they own, could potentially have a larger impact on the overall portfolio, whether that be positive or negative. Whereas Wells and William Blair tends to be a little bit more diversified. Wells tends to own anywhere from 70 to 85 in the mid to large cap strategy, 90 to 100 in the all cap strategy, and William Blair's 50 to 80. A similarity between the two is that all three of these managers are doing research on the individual countries to get the securities into the portfolio, or on the individual names, as opposed to there's no macro type view on top. They're not doing, they're not making portfolio decisions based on what's going on in Brazil, what's going on in Russia. Some of that is taken into account or is factored into their decision-making process, but they're doing research on the underlying companies before they make a decision whether or not to put a security in or out of the portfolio.
Another factor to look at is on page 3 in terms of market cap exposure. As we talked about at the beginning, you have a dedicated emerging market small cap manager in Wasatch that is, of the total assets, it's 1.5%. It's intended to be 40% of the emerging market assets. Dedicated emerging market small cap. So they're focused only on the small cap in the emerging market space. While small cap isn't an intentional focus of WCM, their philosophy and process, as you'll see, leads them to be a little bit overweighted in that small to mid cap space relative to these other two. Certainly the Wells Berkeley Street mid to large strategy is going to have a little bit more exposure on the higher end. As you'll see, they've got about 55% of their portfolio in $15 billion and up, whereas WCM has 30%, and William Blair has about 44%. The WCM strategy has close to 50% in the $1.5 to $7 billion. That is a function of where they're finding opportunities today, and due to the concentrated nature of their portfolio, that could change fairly quickly, but it is something to think about based on what you have with Wasatch. It, at least currently, isn't the most complementary to what you have.
So do you think because of that, the Berkeley mid-large is really a better fit?
I think that's a good fit. It's hard, the WCM strategy is very unique. It's an attractive strategy and a very attractive fee. They're all good firms. They're all good strategies. We wouldn't have brought them to you. And I think from a portfolio construction and what you have today, that mid to large Wells Berkeley Street strategy is the most complementary fit.
Jason, in the comparison that in the book that you gave to us here, it does show on the 3-year risk return, the 5-year, that the WCM sort of leads the pack there. Is that correct? I mean, am I looking at that correctly?
Yes.
That's on page 11 of the report that you guys compared, comparing
Yes.
all of them.
As we probably say every time we're looking at managers, we're looking at 3 very good managers and 3 very good firms that all have very good performance. And if there's a number of other factors that we think are critical in the selection in terms of portfolio fit, as opposed to narrowing it down to 3 great managers and saying, I want the one that looks the best right now. But simple answer to your question is, looking at this page, their performance over the last 3 and 5 years has been the best with the lowest risk.
And a page before that or so, why is their tracking error so much higher than the others?
Because it's such a concentrated portfolio.
Concentrated.
And that's a
30 to
great
40
point.
stocks.
That's a very good point, because their performance, and we talked about this a little bit, the performance, because you own such a smaller number of securities, your performance can look a lot different than the benchmark over different time periods, whereas Wells has a more diversified approach, and so it's going to, the peaks and the valleys are going to be much smaller, and the difference from the benchmark is going to be less.
So tracking error, it's an indication of how much you're going to deviate from the benchmark or how much the manager is willing to deviate from the benchmark. So far, it's all been good, but you have to be very patient with that because it could just as likely go the other way. And if you're not patient with that, that's not a great thing to have.
Your prior manager, Von Tobel, had high tracking error, too. They looked a lot different than the benchmark. And fortunately for you all experienced it on the positive side. As you might recall, Von Tobel's performance was very strong and very good, and they were a high tracking error manager as well. And you participated on the upside. But as we know, all manager performance is cyclical, so it will at some point come down. And so you just have to be comfortable with that in the portfolio.
Do you see any advantages to not having a dedicated EM team in terms of them maybe becoming myopic to other factors in the market?
In terms of, I'm sorry, I'm not necessarily following the question.
If a team isn't solely dedicated, would they have a broader perspective in terms of other factors?
No, I think the way as far as Wells being, the team being focused on EM solely, I think they're certainly looking at other factors globally. They're just not, they don't have other responsibilities. They're not managing a international developed strategy. That was the distinction I was making. So the WCM, the team, the portfolio managers and the analysts, they're doing international developed and EM all within that team. William Blair, the analyst, the security analysts are organized by industry and region. So they're covering U.S. large and small cap companies, non-U.S., and then the portfolio managers are putting together. It's different. As far as perspective, I think they're all looking at those factors. They're taking into consideration macro and global factors to some extent. They're not building a portfolio based on them.
And we like, as Jason said previously, we like all three of these firms. They wouldn't be here and presenting in front of you if we weren't comfortable with all three of these. We have clients invested in all three of these strategies. It's just sometimes one strategy is a better fit with your overall portfolio for another, one reason over another.
And you're still, with Wells Fargo in the mid to large, getting a very attractive fee. For EM.
Is there any concern about, there's about 5% in cash in that Wells large mid-cap?
The cash percentage will fluctuate over time, just as, they're buying and selling opportunities. I mean, if it was, 20%, yes, that would be a concern, but 5% no.
And then also, they indicated that they have about 10% of mature companies also held. That was my only other question.
I don't.
You mean in developed markets, there's 4.2%. That was WCM, but on our page 4, we show 4.2% of the Wells mid to large in developed markets. But what that means, it's a bit confusing, but the stocks are domiciled in developed markets. And again, they're not making a bet on, it's not an asset allocation decision where they're allocating to U.S. or European or Asian developed market companies for an asset allocation decision. They are companies that are deriving revenue or operating in emerging markets that just happen to be domiciled, their headquarters or their incorporation in a developed market.
What's the pleasure of the board? Have any motions to select? Sure, Jim.
Jason, could you talk a little bit about, is it better to stick with a dedicated small cap manager and a dedicated mid-large cap versus going with a firm that's kind of spreading out the investment?
No, I think that still is an attractive setup. I mean, if you recall, the reason we did it was really to get a little bit more juice in the portfolio. While you're not necessarily seeing how defensive your overall portfolio is in your results right now, that's not because of too much risk in the portfolio. It's a couple other factors that we'll talk about. But I think the purpose for the dedicated small cap was to say, look, we know all of the managers we're picking generally have very good downside protection, even in emerging markets, which is the most volatile and risky portion of your portfolio. You've always gone with managers that have good downside protection. So why don't we have some ability to take on a little bit of risk with a dedicated small cap manager to try to get a little bit more of the upside in periods like 2009 and 10. You just haven't experienced that because you got into emerging markets in 2012. But I do think it makes sense.
I believe the gentleman from Wells said something about their fee being 100 basis points, but your chart shows 63.
Right. So the two different vehicles, the all-cap vehicle, which is the third column on ours.
Yeah, the second column, that was incorrect. Where it says ACG negotiated fee of 63 basis points, that was incorrect.
Yeah. So that's the one that's 100, but they're able to bring that down to 93, I think.
90 basis points, it said today.
Okay. The mid to large, which is what we are suggesting, that one, they're able to offer at 63 basis points. And we've negotiated that for other clients that went into that a few years ago when that was first opened, and they've extended that to our clients going forward. So that's available to you. And they're able to do that because the assets in that are much smaller today. So it doesn't violate any most favored nation provisions that they have with other investors.
Any other questions for Jason? Well, I'd like to entertain a motion if someone would like to make one.
I'll make a motion that we go with the Wells Mid-Large Emerging Markets Fund, Emerging Markets Portfolio.
I'll second that. Any discussion? All in favor? Aye. All opposed? Motion carries. I'm sorry. Moving along on the agenda, we are at item 5, the consent docket. We'll take both those items together. Have a motion to approve? Have a motion and a second. All in favor? Aye. All opposed? Motion carries. Item 6 is to ratify approvals. We have one item, the payroll for the month of June 2016. Have a motion and a second. All in favor? All opposed? Motion carries. Item 7 is to approve the claims docket. Have a motion and a second. All in favor? Aye. All opposed? Motion carries. Item 8 is to approve the following applications for service retirement. We have 5 cases this month. We have a motion and a second. All in favor? All opposed? Motion carries. Item 9 is to receive the report of death and authorize the payment of a $5,000 death benefit and approve continuation of the pension to the spouse. We have 2 cases. We have a motion and a second. All in favor? Aye. All opposed? Motion carries. Item 10 is to receive the report of death, authorize the Secretary to make necessary changes to conform on the following. We have 1 case. Have a motion and a second. All in favor? All opposed? Motion carries. Item number 11 is to accept the revisions proposed last month by Renee on the actuarial funding policy. I assume everyone's had a chance to review that. We have a motion and a second. All in favor? Aye. All opposed? Motion carries. Item 12 is the investment consultant report. Jason?
I'll try to be brief because I know we're pushing noon here, but a couple things. I'll touch on the July ASAP, and then Patty's going to give a brief update on where we are and some issues evaluating the custodian. So just big picture in terms of asset allocation, you're roughly in line with your target asset allocation, a little bit overweight to equities, and that's primarily U.S. equities, large and small cap, as U.S. equities have outperformed significantly non-U.S. over the last year, and we're seeing that in some of the dispersion relative to your policy index that I'm going to touch on. Fixed income is slightly overweight. That's primarily been due to good performance in the Core Plus bonds, which is WAMCO, and more recently the global bonds, which actually have come pretty roaring back, the Brandywine strategy, although over a 1-year period that's still been a bit of a headwind. The 2 things that have really, from a attribution standpoint, that have hurt any diversification really outside of U.S. large cap stocks and U.S. Treasuries over the last year ending June 30th were really not helpful. The more you had outside of that, the relative to having that, it was a detriment. In your policy index, 35% of your policy index that we compare to is the S&P 500, which is U.S. large cap, you don't actually have 35% of your portfolio invested in U.S. large cap. We're using that as a proxy for long-short equity, which is the K2 portfolio, which is actually global. So about that K2 portfolio, while it is long and short, it is investing in U.S. stocks, long and short, about 30 to 40% of that is in non-U.S. stocks. So there's a bit of a mismatch there. So it's it's not just hedge funds that has been a problem relative to your policy index, it's that you have a little bit more non-U.S. The same is true on the fixed income side. So 30% of your overall policy index is in the Barclays aggregate, which is a proxy for U.S. investment grade bonds. That index is made up almost 75 to 80% of U.S. treasuries and agencies and agency-backed mortgages that have a high degree of sensitivity to the direction of U.S. rates. Your fixed income portfolio has very little sensitivity to the direction of rates. So you're not getting the benefit of the 10-year Treasury going down from 2.25 to 1.3 at various times of over the last 7 to 9 months. So those two things have had a pretty significant impact. If you look at the second page of the ASAP, long-short equity, which is K2, down 8.4%, so that here we show it compared to the HFRI fund-to-fund strategic, which is a proxy for equity-oriented long-short hedge funds. So that's about a 2% difference. But in your policy index, again, we're comparing to that 10% to the S&P, primarily for a risk comparison over longer periods of time. But from a performance comparison, that's about a 14% difference over the last year and 10% of your portfolio. So if you go up to the top and we look at the 1 year, your total portfolio gross of fees is 1.76% return. Your policy index is 3.58. Well, that long-short equity exposure is 140 basis points of that dispersion. And it's primarily a result of some non-U.S., a pretty significant component of non-U.S. exposure within the global equity, so a bit of a mismatch. And the private equity is similar. Your private equity, you have a 5% target to private equity. It's up 1.7% in a period where the S&P is up 5.6%. So that's the other 5% that we're comparing to the S&P. And so those things aren't going to match in the short term. Longer term, we've still seen the defensive protection that's been offered by the long-short equity, as well as the mitigation to rising rates that's been offered by the absolute return, or PAMCO, but it hasn't helped in this declining rate environment more recently. So that's really the dispersion there. But overall, 3 and 5 years, your portfolio is performing as we would expect. Longer term results are in line with expectations with much lower risk as we have seen. No manager issues that we're concerned about, and we're addressing the EM. Did want to bring the board up to speed on some issues that we've been addressing with the custodian, and Patty will address that.
So we've been working with Renee and Bob to evaluate a new fee proposal that J.P. Morgan was proposing for custody services. J.P. Morgan is your current custodian provider. And during that process, there were some questions that arose that we went back to J.P. Morgan with, and based on some of the answers, we were uncomfortable with some of their responses.
Just to back up, the reason why we were evaluating a new fee proposal was because we were looking to move to a different platform within J.P. Morgan, a different custody platform that offered a few more bells and whistles. It was a more updated technology platform.
And the current platform that you guys are on, J.P. Morgan has 2 platforms. The current platform that you guys are on is going away. And so all clients are either being terminated by J.P. Morgan or have to switch to the new platform. So as part of that process, we were reviewing the new fee proposal. And during that process, some questions came up. And in the end, just to make to make it brief, there were some questions that came up and we were uncomfortable with some of their responses. And so we've been communicating with both Bob and Renee on some of that, and in the end, made the recommendation to issue an RFI to other service providers out there to see what their fee proposals would be, and so that you guys can have a look at what other companies have to offer. So we issued an RFI to four other providers: State Street, Boney Mellon, Comerica, and Northern Trust. The RFI is just simply a request for information. Those responses are due back next Tuesday on August 16th. Once we receive those responses, we'll work with both Bob and Renee to summarize the information and provide you guys with further information. But really wanted to let you know that there were some issues that arose with J.P. Morgan. We were uncomfortable with some of their responses, and we've issued an RFI to gather additional information on some other providers.
It appears to us and staff think that they've overcharged you or potentially overcharged you going back a few years. There's some discrepancy as to what the actual asset-based fee applies to, what accounts it applies to and doesn't, and so we're looking into that. It's not a huge amount, but it does appear to be something that it's worth looking into, and we're just not comfortable with how they've responded.
And there's no definitive answers yet as to whether there's no, the outcome hasn't been defined yet, so we don't know if they have been overcharging or undercharging, but there were issues arising from how they were going about doing the charges. And so they're looking into that. We're looking into that as well, and we'll provide further information
We're trying
as
to
it becomes available.
fast-track getting proposals from these other custodian banks because we think it's something that bears attention.
Just in ballpark figures, what's the potential?
The reason what's challenging is there's the current fee structure is asset-based on separate accounts only, and it's supposed to be 1 basis point, and I think they were charging 2.
Yeah, so you guys had a new fee agreement in 2008 that came into place, and in that fee agreement, it outlined how the fee should be charged. And when we were on the new fee proposal, they had a minimum annual fee. And when we looked at that minimum annual fee, we said, well, what were your fees last year? What did you pay J.P. Morgan? Because we wanted to see if that minimum annual fee was a lot higher than what you're currently paying. And A, it was, but we were able to negotiate that minimum annual fee down. I think it's still a little bit higher than what you've been paying. But when looking at that, we were also noting that the way that they were going about charging was incorrect. In the end, I think, and this is a guesstimate based on some work that we've done and that they've done, but it's still being evaluated, it's a couple $1,000s per year. It looks maybe like 4 to 5 per year.
So it goes back 8 years, so it's 40 to 50,000 potentially.
You had me nervous for a minute.
Yeah, it's not a huge amount, but it's meaningful enough to say, hey, wait, what's going on here?
And it raised some integrity issues and questions.
Exactly.
Coupled also with, there's been customer service issues that we've experienced not only with the people assigned to your account, but we've experienced across other client accounts. And I know Bob and Renee have had issues with getting responses and timely responses and getting information and certain reports that would be helpful for different accounting functions. And so we just said, hey, listen, J.P. Morgan's not the only custodial provider out there. There's other candidates and other providers. Is there any reason why we can't issue this RFI? We can gather the information and provide it back to you. And there's other candidates out there that you have a choice to use.
Is there any question about our ability to recover if the overcharges are confirmed?
I don't think so. We're working through that.
And just from the staff perspective, Jason and Patty outlined this pretty well for you, but as Patty mentioned, we've encountered a number of service issues in recent years. Just in the past year, we've looked into reporting problems related to our annual financial reporting, and that's really what brought up the discussions about the platforms and transitioning and that sort of thing. So overall, and you take into consideration the service issues, the reporting problems, and now some of the concerns that we're having and looking at, the billing issues. We agree that it's an opportune time to take a look at our other options out there to see if it might be worthwhile to look at another custody bank.
And on your question, Jim, I think you haven't paid the last quarter
Correct.
bill yet, so to the extent you hold off doing that, that may be about what the difference is.
Well, I know I speak for the board. We appreciate all your due diligence and looking into that.
That's all we had. Thank you very much.
Okay. It's lunchtime. Item number 13 is comments from board staff and citizens. That's right, I can't add it. It's too late.
I'd like to thank Jason and Patty for, all three of the presenters today were just excellent. I would have felt comfortable going with any of them. And fee reductions that you're able to negotiate, that's wonderful. I just appreciate what you guys do for us. Thank you very much.
I'll second that, definitely. Okay, we are adjourned at 12:01. Thank you, everyone, for bearing with us. It's part of the job.